So in my opinion, like the best way to manage your risk is actually through quality financial planning. So risk is like energy in the fact that you can't create it, you can't destroy it, you can simply convert it. So risk does not equal return, right? Risk equals the possibility of more return.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Welcome back to another episode. Joining me today is Carissa, one of my partners here in the office in Utah. And today we're talking about something that's really quite philosophical, which don't turn the episode off right away. We're talking about risk. And the reason I say it's philosophical, Carissa, is because it is something that you really truly can't quantify. Okay. Now, academia has tried to quantify risk, right? There's risk scores out there. There's programs that try to quantify and help clients visualize risk. There's different measures of risk like standard deviation, volatility, maximum drawdown. There's ratios that work on this quantification of risk like Kalmar ratios or Sharpe ratios or Sortino ratios, right? Like these foreign terms to most people that have tried to describe what risk is, right? Or how risky an investment may be. And the truth of the matter is we only have those because academia really tried to say, well, this is an issue for investors. We have to quantify it somehow. We need to quantify it. And largely what they ended on was standard deviation or volatility metrics, right? And I don't really believe that to be an accurate representation of what risk is. And the reason why is because it encompasses really just one type of risk, not what risk really truly is in of itself. So, Howard,
I also think that it's an indicator of volatility is an indicator of risk.
It's an indication of the potential of risk or the presence of risk, right? It's a reminder that it's there in present, right? Howard Marks, he actually defines out risk as just simply the presence of a possible outcome other than intended. That's it. And if you think about how I really actually like that definition, this is really the working definition I kind of utilize and begin my framework with as not only an investment advisor, but somebody managing my own assets and financial life, right? And simply put, that encompasses things like, well, you can put money in a savings account and the volatility isn't there. And so a risk score may say it's not very risky, but if the outcome is trying to protect the value of a dollar, what can my dollar buy today? And I want it to buy something in 30 years. You can't quantify really the inflation risk. Yeah. Right. You can't control the inflation risk, and we have no idea what the inflation risk will be over the next 30 years. You can make an
assumption of that risk,
but it's only that. So even putting money in a high yield savings account carries some kind of really a lot of risk. It's not volatility risk. It's not that you see your account balance go up and down every day,
right? But
there is a risk. And that thought exercise, as I studied a lot of this risk stuff earlier on, led me, and to give credit where credit's due, this actually came through a conversation with me and Arrow in the office. And what we had kind of landed on is risk is like energy, right? So risk is like energy in the fact that you can't create it, you can't destroy it, you can simply convert it, right? So anyone that studies energy knows that to be true, right? You have energy at the top of a waterfall or a water source, right? And it has potential energy, right? But the energy's there, and as it comes off, you're just converting it. You pass it through a hydroelectric dam, and you've converted that potential energy into electrical storage. You've converted it into something else, but you can't create energy and you can't destroy it, right? you can convert it. I can take the energy of calories and put it in my body and convert it into motion and lifting weights at the gym or going on a run or using my brain power. And that is a really tricky thing to now think about in terms of how do I navigate everything in my financial life when really everything kind of has almost like a point of risk to it. If you wanted to try to quantify it, and it all nets out to 100, no matter what.
Yeah.
And you simply only have the opportunity in your financial life to readjust which areas or what types of risk you want to overweight or underweight, right?
Right.
I want to overweight, as an example, I want to overweight an annuity because I want something very safe, However, at that point, you're overweighting as well to kind of offset it, right? You're overweighting currency risk. You're overweighting solvency risk or credit risk, right? If the insurance company goes out, you don't get your money. You have a contract to only get paid back in United States dollars, right? You can't get the annuity to pay you back at a inflation adjusted rate in Bitcoin in the future or something like that, or Japanese yen or whatever, right? It's like it's currency denominated. It's a contract. You're taking on inflation risk. You're taking on the risk that the insurance company changes the terms of the contract on you, right? In terms of crediting potentially
Business
or something like
risk,
that around business risk. You're taking on liquidity risk, can you get it? How fast can you get it? How easy is it to get at? And so you're just saying like, well, I got rid of the market risk. It makes me feel really good.
Yeah.
But you've allocated more to these other, these
Areas.
5 other risks.
Yeah.
So you're still the same net amount of risk. It's just, if that makes you feel better and you're okay with those other 5 risks, then maybe that's a good thing for you, right? The same thing is true for any financial decision basically that you could think of. Try me.
All right, let's think. Life insurance. Let's just talk about insurance.
Basically the same issues as the annuity.
Yeah,
the same,
that's true. Okay.
It's 2 insurance products, largely the same issue.
Give me a hint here of like what direction.
I don't know, just any investment or
Okay. Let's say Bitcoin.
Bitcoin.
I think that's a hot topic right now.
Yeah, like what are the risks you
what are some of those risks?
So the attractive things about Bitcoin, right, is hey, I'm really uncomfortable with this risk of the United States dollar and inflation and debasement.
Yeah.
So I'm gonna allocate to something like Bitcoin, right? Okay. It's great. It's still like, although people that are, the Bitcoin evangelists or enthusiasts will tell you it's this, very safe asset over time and you have to just look through the noise. You're taking on volatility risk, right? Well, life changes and life changes quick. And if Bitcoin went from 100,000 to 30,000, although 3 years from now it might be $1 million, but you need it when it's 30,000 and you got to convert it back to United States dollars because that's the currency you live in and pay your taxes in. Right? This is a big risk. So you're taking on currency risk, volatility risk. With Bitcoin, you're not taking on liquidity risk largely. There's maybe some more nuances around inelasticity of supply and demand. But like you're still taking on those risks.
Yeah. How about bonds?
Bonds? Yeah. Like you're taking on, hey, I want a portfolio of bonds because bonds are safer than stocks.
Yeah.
Right. Bonds have this endogenous return profile, meaning that the return comes from inside the nature of the contract that is the bond, not from relying on outside forces or somebody being willing to pay you more for it later on. Right. And that's what's supposed to make a bond largely. It's one of the big components that's supposed to make it safer. However, currency risk, big one, right? You have to get paid back in United States dollars. So there's a saying, people tout around sometimes, that, no one went broke investing in stocks in Weimar Germany. So hyperinflation happens. People that invested in stocks didn't get wiped out. They didn't realize that, have that same experience with getting wiped out by hyperinflation because what they owned was an asset that just happened to be priced in Reichmarks, I think is what it was. Right. And so as inflation went up, so did the price of their assets.
Yeah.
Right. Maybe unreasonably so, but nonetheless, like they could sell it at a future date to get, Reichmark's back,
Right.
and however, the older generation in Germany actually really, really, really struggled through that hyperinflation because they generally wanted safer investments, something like bonds. And so they tended to invest in bonds.
Mm-hmm.
And what happened is they got paid back. But remember, it was like a hyperinflation scenario where the price of a cup of coffee was going up throughout the day.
Yeah.
So yeah, they got paid back on their bond, but it was like worthless dollar,
Yeah,
it was
like
worthless
pennies on the
currency,
dollar,
in terms of purchasing power, they lost everything. And so currency risk in that debasement is huge with bonds. In fact, that's why we've seen a lot of the volatility in the bond market. And for those that have paid attention and have been following me for a while, like I made the call and kind of had the prediction that if they dropped the interest rates, the Fed dropped the interest rates last year, that the mortgage rates were going to go up.
Mm-hmm.
Most people thought I was crazy because they don't understand how it works. But what happened is the Fed started dropping that rate, which potentially stokes up the economy
Mm-hmm.
and increases the credit availability, which increases inflationary impulses. And the bond market simply said, which the Fed doesn't necessarily control,
At least
said,
not directly.
we're not going to be your, old fogies in Weimar, Germany, owning the bonds and getting destroyed. We're selling our bonds. We're not going to own this.
Yep.
And as they sell them, it pushes the yield up. Well, as the yield gets pushed up, it pushes the interest rates up, which is why mortgage rates went up at the same time, right? And that's a risk that, institutional investors are very in tune with and saying, look, bonds are supposed to be safe, but they're not when we don't have, we're not wanting that currency risk. And so credit risk, they might be okay, but the currency risk, they're not okay with, and they don't want to get paid back in debased currency. And so that pushes the interest rates up higher.
Yeah.
So bonds, all else being equal, like maybe haven't been as safe the last couple of years. Now,
2022 is a good
great example
of that as well.
And from a portfolio construction standpoint, people said, well, I want stocks and I'll have bonds for my sort of safety net of crash protection, because when stocks go down, bonds should go up. And in academic papers, yes, it has looked that way for several decades. However, once bonds are basically at zero yield, the thing that makes them go up when stocks go down is that people want the yield. They want to buy the bonds. And so if stocks are going down and at the same time people are saying, dude, we don't want your bonds because inflation's going up and you have to raise interest rates on the short end to try to tame this inflation.
Yeah.
We don't want to own your duration risk. So
they no longer look
we don't want to, yeah,
right?
they don't want it. They really just don't look attractive. They sell off. And so people lost money on both the stocks and bond side of their portfolio, which is really, quite uncomfortable for most people. That has changed a little bit in the current environment because bonds now have a yield to go down if, market goes to a risk-off environment. However, I still urge people to be cautious because we are still largely, is my belief from a macroeconomic framework, that we're still battling some of the last sort of embers of inflation. And if the Fed moves too quick to lower interest rates or Congress passes too big of spending bills, and we keep seeing these in the bond market, these impulses where the bond market says, we're not playing along here. If they do that, you could see a major sell-off in the bond yields. So even though there's room for them to go down and thus push the prices of bonds up, that doesn't mean that they have to. And they might have, it's a little bit trickier and more nuanced, I think, than some people would expect on its face, right?
I want to pose this question to you then, as far as, because we're kind of talking about asset classes in like terms of risk. Do you think that asset classes themselves are like the same type of risk across asset classes?
What do you mean?
I guess like, would you say like a bond is safer than a stock, or like an asset?
No,
class
I don't think
itself?
I don't think anything is safer than any other investment. And the reason why is like you're simply trading. You always have the same net amount of risk.
Right.
So like. Now,
I guess across the asset
I guess maybe
class,
where I could be
like,
wrong is if you're like, is this meme coin safer investment than Bitcoin? They carry the same amount of risk. You know what I mean?
'Cause
I don't know. Like, I think scams and frauds aside,
Yeah.
which I think most meme coins kind of fall under.
I mean, I
under
guess
that,
I'm
but
going back to a prior conversation that we've had. Like, not all stocks are created equal. Not all bonds are created equal. Not
it's
all,
totally,
real estate is created equal. So within an
yes.
asset class, just because sometimes it's been deemed as a safer asset class, I don't know that that's really true in essence. Like, you can't really base the risk
well, even if you
amount off of that.
So dig into stocks, right? Dig into like, is technology a safer investment than is that a less risky investment or a riskier investment than owning utility stocks, right? Those are the kind of the two ends of the spectrum, largely in the market, in terms of, like, if you're looking at like large cap or sectors, right? Technology is kind of the most volatile. Utilities is kind of viewed as the more secure or safer options. And the reality of it is, again, to what extent are you going to say, well, tech stocks tend to inflation adjust better and can ride out inflationary impulses better. Thus, it can also starve off or essentially kind of de-risk me from maybe this inflation or currency debasement idea, right? A little bit better. So are they riskier? You know what I mean? It's like, to what extent are you using to measure risk? Because if you're just using volatility as a metric, then tech stocks look way more risky than utilities. But if your goal is to make, large returns net of inflation, then you might actually be carrying more risk in the utility stocks because it's not going to get you to your financial goal.
Right.
It may well not make it to your financial goal, right? So you have to really have a framework and understanding of like you are always going to have some kind of risk. What risks am I okay having and what allocation? Because maybe I'm always going to have some of all of the risks.
Mm-hmm.
But maybe I can sort of overweight or have more of one risk that I'm comfortable with and have less of another risk that I think is less favorable, right?
Yeah.
And when we build portfolios, that's largely what we're doing, is saying, I don't want this kind of risk. I will take this kind of risk, right?
Mm-hmm.
I don't want the risk of never retiring because I can't save my way when inflation's printing. I don't want that risk. Thus, I'm going to take on the risk of the volatility of the stock market in the near term because it's likely to produce a more meaningful return and outpace inflation, and I'll stay invested, and it's a long time horizon, right? So I'm willing to take on volatility risk to get rid of this debasement risk, right?
Yeah.
Like, that's simply the trade you're making. Hey, thanks again for following along with us on the Ducharme Wealth Management Podcast. We really genuinely appreciate your support in the project. Please, if you haven't, subscribe real quick. It does help a lot. And if you have questions, you want us to take a look at your own situation, you want us to take a look at an investment statement, you want to run some advice you're getting somewhere else, just pass another party for a second opinion, you're trying to dial in your retirement plan, whatever it may be, please reach out to us. We are always happy to do consultations for our listeners. You can find us at ducharmewealth.com. From there, you can schedule appointments with advisors that you think you would like to work with, including myself or Carissa in St. George. And we can help clients, again, across the country, pretty much all 50 states. So please don't hesitate to reach out. We'd love to see if we're a good fit and can add value to your financial life. DucharmeWealth.com, and we will see you out there. Enjoy the rest of the show. You can dig deeper to companies and do the balance sheet analysis and, kind of the Warren Buffett method and say, we're buying at a
valuation,
intrinsically discounted valuation, right? We're buying below an intrinsic value. However, like, even at that, he's still taking on risk, okay, well, like, he's buying a valuation, but he's still paying a price for it. So what if no one comes along and wants to buy it, pay
nobody
what he thinks
that is what it's worth?
If valuation never comes to meet the price, that he's expecting, or price rather never comes to meet the valuation, it doesn't work, right?
Yeah.
And so he's still taking on this risk of not achieving his goal, but he's taken on a risk. He's maybe negated the risk of further loss or significant further loss, right? So he's managing a specific kind of downside risk in his investment strategy. And then he's largely in a lot of Warren Buffett's method, what he's done is added yield to the portfolio to compensate for the lack of, maybe endogenous return profile in equity investing, right? He's an equity investor. He's not a bond guy. And so what he's looking for is how much can a business produce in net cash flows back to me as the investor, right? Because I want this to be producing a yield. And so now that's, again, starving off the component of, hey, I'm going to own this and I just need somebody to pay more for it a year or 2 or 10 years from now, right?
Yeah.
He says, like, if I own it forever, then the cash flows are I'm getting a great deal on the cash flows, right? He's oftentimes buying the cash flows. And so, again, he's got his own way of looking at it. But you still carry the same net sort of amount of risk, right? It's like, and again, to what extent is he taking on currency risk? Is like, I use currency risk because look, it really matters, right?
Yeah.
That's really where inflation risk kind of lurks. But Buffett obviously takes on liquidity risk, right? If you buy all of Geico, is it by Geico or Progressive that he owns? Progressive.
I'll be honest, I'm not sure.
Yeah, whichever one he owns. If you buy all of an insurance company, right? Like, you can't just like wake up one morning and be like, we need cash, sell the insurance company, and be like, hop on the computer on Charles Schwab and be like, sell all of it and get, whatever you kind of had it valued at on the balance sheet. You can't do it, right? So illiquidity risk is what Buffett might be. You know what I mean? It's like he's calculated what he's taking on, but there's still a risk. And simply what he is focused on is I want to avoid the risk of, further significant loss relative to intrinsic value.
Yeah.
So he uses valuation as his margin of safety.
I think another concept of risk that I find interesting when talking to people is they think of that risk of like the volatility or the potential for loss. And if they take on more of that type of risk, then they expect that they should just get a higher return automatically.
Risk, this is what I try to help people understand with that. So risk does not equal return, right? Risk equals the possibility of more return, right? So you largely cannot have, and which is a really interesting shift because remember, I just said like you net have the same amount of risk. We're really talking at this point now about a certain set of risks.
Yeah.
And basically what I'm going to say is if you expect to get more dollars back in the future, you're going to put more dollars at risk in a nominal sense. So I'm investing $100 and I might see that go to 120. I might see it go to 80, right? But I'm kind of valuing everything in terms of getting dollars back. And I'm putting aside for a minute, what is the purchasing power of that dollar, right? That's a completely different methodology you want to incorporate in a portfolio to maybe handle that risk, but you're just looking at one risk within a portfolio and one investment. And you can say, well, I want to buy a really risky stock. That doesn't mean it has to go up.
Yeah.
Right. Like just because a stock has a lot of volatility like energy the last 2 years has been probably a really good example of that, where there's been a ton of volatility in the energy sector. But it has not, and they just said, well, congratulations. You sat through, all this volatility. Here's an incredible return. Like sometimes it will likely pay off over time, right? So empirically, the more volatility you take on, the more that you should expect to sort of make in a return. Well, there's nothing that says like that has to come linearly.
Right.
Or that you can't go through years of very uncomfortable periods where you see no meaningful progress, or you make a bunch of progress and you lose a bunch of progress and you make a bunch of progress and you lose a bunch of progress. And then all of a sudden in 1 year, you just make all the progress you would have ever hoped for, right? Like that can happen, right? And the reason why I say it's the presence is it never owes you the big return at the end. And B, remember, if you hop off right before the big return ever happens, it doesn't matter if you sat through for 9 years and in year 10 is when the big return happened. You don't get the big return. You just got all the pain along the way.
You shouldn't expect to make any money if you're not taking any risk.
Yeah. And likewise, when you have somebody say, look, this has no drawback, it's the holy trinity, right? Of investments, right? It's very safe. It's got a great return and it's liquid. You can get your money anytime. Don't turn around and walk away. Like run
as fast as you can,
faster than you can somehow. Like call friends and ask them for help to make you run faster, tie bottle rockets to your feet and try to blast off faster. I don't know. that is something that just the math doesn't work, because remember, the risk I'm willing to take on is I'm getting paid or compensated for that risk because you didn't want it as the other side of the trade, right? And so
I think that part is something that people forget too, is that there's two sides of that, and you've got to have somebody on either side of that coin.
If the S&P 500, for example, as an index, just went up 10% a year, why would anyone have a high yield savings account? Right? Like,
yeah.
The issue is that it's still a market of stocks that still move, that still have underlying business fundamentals, and it will move up and down, and you can't control how it moves up and down. And sometimes it moves up and down for not economic reasons, but simply because there's maybe mandates from big people or whatever that they got to sell more, right? And so all of a sudden in 1 day period, like there could just be a lot of selling pressure. I think largely today, actually, that we're filming, we saw that. I think there was a kind of a regrossing of hedges by hedge funds in mass in the market, and it pushed the market down today. Like from a 1 day standpoint, a bit uncomfortable for most people.
Yeah.
But again, if you're long term, you look through that and say, okay, well, the person that needed their money maybe any day wasn't okay with that risk, but I am 10, 15 years out or 20 years out. I don't really care what happened today. I don't care if it went down 3 or 4% today. It just doesn't matter to me.
Yeah.
I'm zooming out. I'm like, where's it going to be in 20 years? That's literally the risk that you're getting compensated for taking, is that I'm not going to look for 20 years risk.
Yeah.
Right. That's it's largely what we do as investors, is in the same way that you pay a premium to an insurance company because you say, if I get in a wreck in my car, I don't want to pay to fix my car or buy a new one. So the insurance company says, okay, we'll take on the payments from everyone. You transfer it to the insurance company, and what they're doing is saying, man, there's going to be years or days, weeks, months, or years where we got to pay out a lot of claims, and our profitability might not look great for a period. But we know that if we collect these premiums over a given enough amount of time and we do proper underwriting, right? We try to not take on people with a propensity for getting DUIs or accidents, or people that do a lot of texting and driving. Then statistically we can kind of adjust this to be favorable, that we can get compensated for taking on this risk, that there's going to be periods where we're having to pay out a lot of claims.
Yeah.
When you invest in something like the stock market or even a stock in general, you're largely just doing the same equation, right? You're taking on the risk that there's going to be periods of uncomfortableness, right? That the claims have to be paid, so to speak. Not everything's sunshine and rainbows, but you know that if you do it, if you have good underwriting practices and you make good investments over time, it works out. And some investments lose out, just like the insurance company, right? If you sign up, you give them $1,000 in premium, and 3 weeks later you get in a car accident, like they've lost $30,000 on you probably, right? Like it is the worst deal ever for them. But they know that if they keep playing the right game long enough and they keep doing the right calculus and underwriting, then the risk that they're comfortable with is, we're okay with the risk that somebody gets in an accident, or that there's this volatility of returns for us. It's what they do, and it's kind of what we do as investors. It's just, but remember, the only reason that we have that available to us is because somebody else wasn't okay with that risk, and they wanted to offload that us to as offload that risk to us as investors. Sorry, I can't talk.
It's all right. Yeah. It's just that transfer of risk from one person to another, and you get that premium essentially for being able to take on that risk. That's the goal.
Yeah. Bonds are largely the same way, right? Gold is maybe speculative in nature, some people might say, but just as another example, like gold is like, I'm taking on the risk that, like, so, somebody says, I want to sell my gold because I want dollars. I feel more comfortable with the risk of owning dollars today because I got to go pay my tax bill. I got to go buy something. I got to go spend it, whatever. I'm going to sell my gold. And I, on the other side of the trade, I'm saying, I don't want dollars because I've got a longer time horizon and the government keeps printing money and inflating and whatever. Right. So like, maybe I want to buy gold, and people say, well, this is speculative in nature. That's true. Totally true. I'm taking on the risk, right? That, intergalactic here in St. George who's working with like SpaceX to figure out how to mine gold out of asteroids, figures it out, and all of a sudden they're sending rocket ships back to Earth full of gold. I mean, my gold will not be worth a lot of money at all if that happens, right? But that's the risk. So I'm simply saying, I feel comfortable with that risk. I don't think it's going to happen. I don't think that they can figure that technology out really.
Or within my time frame.
Within my time frame even, right? But I certainly think, in my opinion, Congress can print money within my time frame, or Congress can spend money. Credit can be created. The Fed can ease rates and make conditions easier for credit creation, which effectively increases the money supply and debases my dollar.
Yeah.
So I feel better about just me personally, right? In that scenario or in this kind of exercise, feel comfortable with gold, right? Yeah. And I'm simply taking on that risk. But the person that had gold said, well, although it should go up over time, I might need to spend money in a period which it might be down. So I'd rather just hold some cash right now, right? And that's where the financial planning process comes in around all of this is, look, you have, as investors, we all have this unquantifiable risk. And you can look at efficiency ratios and volatility and all this stuff and try to say, like, I want a portfolio that's a risk score of 50 out of 100 or something, right? It's just, it's largely so meaningless and doesn't really inform you on like what your real risks really are. It just tells you about one type of risk. So in my opinion, like the best way to manage your risk is actually through quality financial planning, right? And whether you're a company or an individual, doing the financial projections and having those conversations with your trusted advisors, yourself, your partners, whatever it might be, and just saying like, what is our potential need for money to be spent in the X time frame? What do we do with the money that we might need in that time frame? What about this next time frame out? What do we do with that money? What about further out? What do we do with those funds? How do we invest that? And how do we sort of liability match our life here and say, maybe at certain phases we're comfortable with certain risks, and at certain time phases of our plan we're not as comfortable with other risks. And as we move through sort of time and space, we're going to have to adjust our plan, adjust our allocations, adjust our investments, because we live in a world that really nothing's forever.
Right.
Right.
Yeah. And I mean, change is constant, and you should be updating your financial plan on a regular basis. It shouldn't be a set it and forget it kind of thing. Obviously, you don't want to be doing too much to change it if there's not any major life changes or things like that. But just making those small adjustments to keep yourself on track is important. But you shouldn't be, changing the whole plan, and just making sure you've got your values and your goals in alignment. And then that's how you manage your investments off of that. It's not necessarily that, like that number of risk.
Yeah. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com. And we look forward to talking to you. I think it's largely one of the reasons, that was one of the driving reasons a couple of years ago when we rebranded from Ducharme Financial to Ducharme Wealth Management, is because, we start with a financial plan. But the old saying, right, and I believe this is Mike Tyson saying, right, everyone has a plan until they get punched in the face.
Yeah.
Right? Like your financial plan's great the day you print it off. It's great as soon as somebody walks out of the office though, or as soon as they close down their computer and move on to something different, their plan is largely redundant. I mean, like that's even learned that in school. The CFP board agrees with that. And so what you need to do is continually sort of monitor, right?
Right.
And so wealth management begins with financial planning and kind of organizing everything.
Yeah.
And building a baseline plan. But then there's the management component. You have to go back to the plan and update and refine and run the new inputs of relationships with kids changing or kids, having different interests than you originally thought. And so now their funding needs are going to be different, or you want to support them in a different way, or they're getting divorced, or you're getting divorced, or
income levels change.
You got a big promotion, or you lost your job, or you want to, or you decided, you want to move across the country and cost of living's way different, or you have an opportunity to make a huge investment, or maybe you made a small investment and it went crazy big. And now you have a totally different set of problems on your hand, right?
Yeah.
And so having a baseline so you know the direction you're going, but then wealth management is coming in and saying, what risks lie in my financial life today? And what am I doing to manage those risks? They don't always I don't have to get rid of them because I can't. And oftentimes getting rid of them just means I'm taking on a new form of risk somewhere else.
Yeah. That
if I don't think I have risk is probably lurking, and it's going to be largely disastrous at some point, right? It's like the worst kind of risk is the risk you don't know you have.
Yeah.
But being able to just acknowledge, okay, these are where my risks lie, but I'm okay, or I'm comfortable with those risks, right? I'm okay.
Yeah.
I feel like we can manage around that, or survive that, or deal with that as it would maybe come up, and we can be more nimble, and you just monitor, right? A lot of this stuff.
Yeah.
And that's really like what risk and risk management truly is, in my opinion.
I agree.
Can't be created, can't be converted.
Yep.
Or sorry, can't be created, can't be destroyed, can only be converted.
There you go.
It's risk. Yep. Yeah. I think I'll wrap on that. Always remember, risk is like energy. Can't be created, can't be destroyed. It can only be converted. So you better figure out where you have risk in your financial plan, in your financial life, or your portfolio, and understand how you're addressing it and how you might want to change what risk exposure you have.
I like that.
And if you stayed to the end of this episode, then congratulations. I recapped the entire thing in the last 15 seconds. And, thanks for riding along with us. Thanks for riding along with us. If you have any questions about risk, you want us to take a look at anything, send us a message, comment, contact us. You can always get us at docharmwealth.com. We'd love to hear from you. You can just reach out with your question. We'll try to answer it on podcasts, or we'll get with you individually, whatever we need to do, and answer that question, or really any topic you want to know about that relates to finances. So thanks for joining, and we'll see everyone out there.